Hi everyone. Today, we're going to talk about one of the biggest events in recent history that affected the global economy, the 2008 financial crisis.
In the early 2000s, the housing market was booming. People were eager to buy homes, and banks and financial institutions were eager to give them loans. It was a time of growth and prosperity. But as the demand for homes increased, some financial institutions started to offer risky loans to people with poor credit. These loans, also known as subprime mortgages, allowed people to buy homes with little or no money down, and they carried a high interest rate. The idea was that even if the value of the home declined, the lender could still recover their money because the interest rate was so high. Financial institutions packaged these loans into securities and sold them to investors who thought they were safe investments. They were backed by the Federal National Mortgage Association, FNMA, also known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, FHLMC, also known as Freddie Mac, which were government-sponsored entities that bought and sold mortgages. However, the housing market eventually started to decline, and many homeowners found themselves unable to keep up with their loan payments. This led to a decline in the value of the securities that were based on these loans. This decline in value caused a chain reaction in the financial system. Banks holding these securities found themselves in trouble and didn't have enough money to cover their losses. And as the situation worsened, people started to pull their money out of banks, making the situation even worse. The government and central banks had to step in to try to stabilize the situation. They provided support to the financial system and pumped money into the economy to try to prevent a total collapse. One of the most notable examples was the Troubled Asset Relief Program, TARP, which was enacted by the U.S. government in 2008 to provide financial support to struggling financial institutions. The 2008 financial crisis had a significant impact on the global economy. It led to high levels of unemployment, declining home values, and a reduced standard of living for many people. In the aftermath of the crisis, many countries enacted stricter regulations on the financial system to prevent similar events from happening in the future. For example, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in the U.S. in 2010 to strengthen financial regulation and protect consumers. The 2008 financial crisis was a wake-up call that showed us the importance of stability and regulation in the financial system. It also showed us the consequences that can happen when things go wrong. We need to be aware of these events and learn from them so that we can make sure they don't happen again.